Welcome to the daily update, where I'll go over the action in the market for Tuesday, April 30th, and then we'll see how things look for Wednesday, May 1st. Pretty negative day, especially right at the end of the day. It looked like the market was holding up, but we saw a little bit of selling, which led to a little bit more selling, and then some big selling going into the close. We never did really switch over positive in the short and intermediate term. We still have this overhead resistance above where we've been at, and the market's really having a difficult time breaking through that. Now, we have the FOMC going to make their announcement at 2 p.m. Eastern on Wednesday. They're probably not going to change interest rates unless there's a really big shocker that comes out of the meeting. But it's going to be, what does that report come out with, the scatter plot, thinking how many interest rates they're looking at possibly doing? And then what is Jerome Powell going to say at his press conference, and how is he going to say it? And the market may gyrate around a little bit and try to establish itself. And right now, we could justify going either way. We're going to have to break above overhead resistance if we end up trying to go higher. And we're still looking a little bit more negative now with the technical picture, and that could justify things actually going lower. If we do start to break lower, we'll be watching that 100 period moving average to see if it can provide support again like it did last week. So let's go back and talk about what happened. We did have a lower open, not too big of a deal, wasn't a real gap. Prices then tried to go up, and we hit resistance at the daily pivot at 51.09. That set the high for the day. And then we chopped sideways, and it looked like that's what it was going to be like, just kind of a sleepy day ahead of the Fed. Well, we saw some selling come in. We dropped below S1 at 5,095. As the day went on, prices then kept going down and dropped below S2 at 5,077. We attempted a bit of a bounce back, but that really didn't take. We got a little bit back above S2, but then we had some big selling coming into the market, and we closed actually below S3 at 5,040. So we were down 1.57% on above average volume. That's a bit of a concern. We've been below average volume again. We did see a little shift over last week, but Monday's session was below average. And then to see volume really pick up on a down day is a warning sign to us. We're still negative in the short and intermediate term. We were possibly switching over to positive. We were showing a lot of improvement, both with our indexes and with the indicators that we look at, but we were not able to get above overhead resistance, and we still have not been able to get above that. And now we're starting to fall back from that. It's about the Fed in Wednesday's session and what's their take going to be when it comes to inflation, and what are they going to do concerning interest rates? And so the market's really trying to figure that out right now. We want to keep an eye on the geopolitical issues. There's really not much going on that's impacting the market, but that could always change. It's mostly about the protests going on in the US, but that really doesn't have an impact on the market. Some comments. It was a broad-based decline. The mega caps got hit just like everybody else, and it was the last trading day of the month. Now, we did have negative seasonality going into this day, not just neutral to negative, but flat out negative. For some reason, the last day in April tends to be quite negative on a historical basis, and it lived up to that in Tuesday's session. The S&P did end up falling 4.2% in April, so it was a down month. We saw really solid upward moves for the first quarter, and now we're seeing a pullback. We're kind of more in that pullback to decline area right now, where if we get down to the 10% level, that would be considered more of a correction. And interest rates keep going up. The 2-year yield closed over 5% now at 5.05%. On a short-term basis, we're still looking extreme with our slope oscillator, and it's still above its moving average. But if we see some more follow-through selling, we could lose what had been turning more positive. But in the long term, we're still hanging in there. The 150 and the 200 period moving averages, they're still extreme positive. And yeah, they came down, but they're still hanging in there for right now. They're not really declining at this point. And we're wondering how this scenario is going to shift. Where it looked like the Fed was pretty much done raising rates. Now they might be done raising rates. We'll see if that changes after Wednesday's session. And are there going to be any rate cuts in 2024? The market had started off the year thinking 6, maybe 7, then it dwindled down to 3. Is that going to even dwindle down even more? And so you had a lot of this expectations, and they've been pushed out further. They thought it was going to be March, and now we're looking at May, and then we're looking ahead at the next meeting. So the thing that I want to say about the market is I watched a few people saying, "Oh, the market, they're wrong about things. They're wrong. They're wrong. They're wrong." That's not the correct attitude that I take. The market is always right. It may not be correct, but it's always right because we have to follow price and we have to do things based on what price action is actually doing. It may not logically make any sense, and it may not make sense to economists or to analysts, but we still have to follow what's actually going on. So we always have to say price is right, just like the famous TV show, but it may not be correct. It could go against our logic. It could go against some of the things that we're seeing as far as what's trying to be discounted into the market. And maybe that will take a little bit of time, or maybe it will just go away as those other things try to get discounted. Remember, there's human logic and there's stock market logic. And to be successful here, we have to follow stock market logic. The dollar was up and interest rates were also higher. We closed at 4.69% with the 10-year yield, where we had been at 4.61%. We're still inverted with the yield curves. Sentiment did tick down. We're at 41 and it's negative. And where it had been at 43, it was still negative, but now it's just a little bit more negative. Our trend is still negative. We have the red line on top. The ADX is still weakening. We're still dropping below the moving averages. We haven't really crossed back above them yet to show that the negative trend is really picking up steam to this point, but that could always change. We are above 20, so we're still in a trending environment, but it's a weakening trending environment. Our bias is negative with the down day, and I'm still keeping our momentum at mixed. We were showing a lot of improvement over the last number of trading sessions, and it looked like we could actually switch over positive. We just couldn't get above that overhead resistance. Now, with the downward move that we saw on Tuesday, we just have to see what's going to play out in Wednesday's session. The reports that we had the first quarter employment cost index, and this spooked the markets a bit, but they didn't have a real initial reaction to it. It came in up 1.2%, more than the 1% they had expected, and up from the 0.9% that we saw last time. And this going up could be considered inflationary. The FHFA housing price index also went up 1.2%. Last time it was down 0.1%, also could be considered inflationary. The Case-Shiller home price index was up 7.3%, more than the 6.7% that they had expected, and up from the 6.6% we saw last time. Also could be considered inflationary. But the Chicago PMI, it declined. Last time it was at 44.5. This time it came in at 37.9. They expected 44.5. Last time it was at 41.4. Consumer confidence, this rattled folks a little bit here. They thought it was going to come in at 104. It came in at 97. Last time it was at 103.1. So here are some charts. The blue line are total, and it's flattening out here on a year-over-year basis, but it had been declining, and the market liked that. Well, now with it flattening out and possibly even starting to go back up, that could cause some concern. We are still seeing a decline with the yellow line. That's wages and benefits, but the total looked a little bit stronger. The FHFA housing price index continues to go up, and the Case-Shiller home price index, it's not up as much as it was before when we look at this, but it is continuing to be fairly strong. And then the Chicago PMI, it's been trailing off lately. This just shows weaker economic conditions in the Chicago area, which kind of bleeds over into the whole Midwest. And then consumer confidence. We look at the blue line, which is total. Folks are getting a lot more pessimistic. They see everything that's going on. They're concerned about inflation. They're concerned about the upcoming election. And so we're seeing folks not as confident. When we look at the purple line, this is how they're feeling right now, which is not as good. And then the yellow line is how do people feel looking out into the future? They're also not looking as optimistic as they were before. Some Isabel Net blog charts, risky versus safe assets. Now this might change with the down day and if we really shift over and look more negative. But when you take this flows going in here on a 4-week moving average, more money is going into risky assets, which means stocks, rather than safe assets, which are considered to be bonds and things that are less volatile. The financial conditions, this had been going back up, showing that we were getting a little bit tighter. Then it started to back off. It's ticking back up in the latest chart that we're reading now. And then the length of time from the last Fed rate hike to the first cut, this is just an average going back into the 60s. When did they last hike rates? And then how long did it take for them to cut? Right now in 2024, we're showing a reading of 10 here. I guess that's months, not years. It feels like it, but 10 months. And then bond fund flows. And I won't go through this all in depth. I'm just going to focus more over here on the left. This is money going into bonds, and then it breaks them down according to what kind of bonds they're in. And then it goes over the past few weeks to see how money's been flowing in there. And we are seeing a real pickup in bank loans, at least at the beginning of the month, and that held on pretty strong as the month went on. And then earnings sentiment, where we look at the dark blue line here, that's the S&P 500, where it is coming up. Folks are feeling a little bit better about earnings compared with all of the other markets across the globe. Didn't find anything on Twitter. Lots of things being said, but nothing really substantial. Not sure where we're really at here with this cycle chart here. And I tried to look for an update, and it really I didn't find one for right now. So here's our chart where it looked like it was going to be a pretty quiet day. We had kind of a flat to higher, a little bit lower open, and then we just chopped sideways. And it looked like, okay, we're just going to kind of hang on and see what happens. Well, we ended up dropping, and there's some lines missing on here. We dropped down below S1. We came down below S2. We tried to bounce back up above S2, and then finally we ended up closing down at S3. The intraday chart just saw the weakness. The futures held up pretty strong, but then when the economic reports came out, that's when things switched negative. We tried to bounce up from that, and then we saw some selling, and then a lot of selling going into the close. We're pretty much flat in the initial overnight session. This is still positive, though. We still have the blue line above the red line, meaning growth is still outperforming value, but they both got hit, and you can see right at the end of the day, growth really got hit pretty hard. We also showed a decline here with our growth to value ratio for the S&P, where it did end up going lower intraday. When we look at our end of day charts, growth was down more than value for the large caps, mid caps, and down less for the small caps. So we turned down with our end of day chart with small cap growth to value. When we look at the ratio, we turned down with mid cap growth to value, where we had been seeing some slight improvements. Well, we also ticked down with S&P growth to value when looking at that ratio. This is still holding up for right now. We had come down to this 250 period moving average, bounced up off of that. Now we're pulling back a bit. Where we're going to get really nervous is if we drop down below the 250 period moving average. And after we had seen a nice little bounce with discretionary versus staples, well, that pulled back on Tuesday. Large cap growth just cannot get above its 50-day moving average and is declining from that level. The Wilshire barely, well, almost got up to its 50-day moving average, but also declined. This is a broad market measure showing that the selling was across the market there. Here's our trend where we're still kind of right on top of the moving average, a little bit below it. The red line is still on top, so we still default to positive, and we're still down below the moving average with our short term, with the red line still on top. So short and intermediate term, we're still defaulting to negative. We did pick up with volume, showing our oscillator here. Monday was below volume, and then we saw it pick up to above average on Tuesday. Sentiment, this hasn't been updated. It should be updated in the next few sessions here. The Ulcer Index is still giving us a pretty high reading, showing that there's fear. With the down day, especially right at the close, we did pick up with the VIX when we look at the line chart and the bar chart, and we're starting to cross back above the moving averages. We also saw a pickup in the volatility of the VIX, but a lot of that came right near the close because it looked like volatility was really continuing to drop off. The momentum for the VIX still continues to be down, but if this starts to shoot back up, we're going to see the MACD turn and go back positive, but we're not there yet. The equity put call ratio actually ticked down just a little bit, kind of surprising on a down day. So we're still declining with our 5-period moving average. And we didn't see much of a reaction here with the volatility risk premium. It's coming down below the band here. You would think it would have spiked up, but it just didn't do that in Tuesday's session. We did go back up with this fear gauge, and we also increased slightly with this other fear gauge. The advanced decline line, we were down based on price and volume. We were showing some improvement after Monday. Now we're seeing a little bit more things to be concerned about after Tuesday. But this is still encouraging. We still saw, a little bit less new highs on Tuesday than we saw on Monday, but a lot more new highs than we're seeing new lows, even with the downward move. So the raw score is holding up, and so our 5-period and 10-period still continue to go higher. The advanced decline ratio did drop below 0, so that's a little more negative. And the accumulation distribution, which was looking a little more positive, has now dropped below the moving average. The Chaikin money flow, which had been showing some improvement and hoping to possibly get positive, nope, it ended up declining and is looking more negative again. The Chaikin oscillator is still above 0, so it's positive, but it did decline. And when we look at the cumulative advanced decline line, that really came down and dropped below the moving average. We're down just a little bit below the moving average with our regular NYSE advanced decline line. Also just a little bit below the moving average with this other NYSE advanced decline line. When we look at the common stock based on price for the NYSE, we did decline here, and we're declining now based on volume. And actually, we came down a little bit heavier with volume. It looked like when we were going up, we saw volume outperforming price. Well, we saw volume outperforming to the downside in Tuesday's session. We're still positive with the NYSE new highs minus the new lows. Even though it dropped, we are still above 0. With the cumulative advanced decline line for the S&P based on price, didn't really see much of a change here, where we saw more of a decline based on volume. So that's why I was warning about this idea that maybe volume is leading price to on the positive side. Well, now it's kind of switching over and looking more negative. We did decline with our advanced decline line studies with the NYSE common stock, the S&P, the mid caps, and the small caps. And with the top 3 actually falling below the moving average, the small caps never did get back above their moving average. Here's our chart where we were battling with this overhead resistance, and we've just not been able to tackle that, at least yet. And we might have overdone it on a one-day basis, going from Monday to Tuesday. The rate of change is giving us a pretty extreme reading. Doesn't mean we're necessarily going to bounce from here, but it might mean that things will slow down. But at the same time, things could get really crazy depending on how the market reacts to the Fed announcement. And we're just not able to get above the 20-period moving averages right now. They are still providing overhead resistance, and we're falling from those levels. Also, with our double and triple exponential moving average based on 20 periods, we were coming above both lines, and that was showing an improvement. Well, now we fell back down to the double exponential moving average. And we're still looking negative here with our 20-period simple moving average of the open, high, low, close. These lines were acting as overhead resistance, and we've been falling back down below this little mini rainbow. We did turn down with the 20, 50, and 200 period moving average study. We also turned back to negative with the force index. We're going down in the short-term stochastics. We kind of stalled out here at the midpoint with the intermediate term, rolling over a bit, but still trying to go up with the long-term stochastics chart. Where we had been able to get slightly above the midpoint after Monday, now we've dropped down to the border between the -1 and -2 standard deviations channel. Intermediate term, we decline and we're below 0 with the balance of power. The go, no go is still having a lighter shade of purple. We'll have to see if that redraws and looks more negative. And we're coming back down below the midpoint with our highest high versus lowest low values. The TTM squeeze, after it had been trying to claw back up, it's still going up a little bit, but it might start to turn down if we see any more follow through. And we're coming right up to the underside of our triple exponential moving average based on 50 periods. We've not been able to break above that, even on an intraday basis on this chart. And then we fell back down from that level. Here's the 50-period moving averages. hit it as overhead resistance on Monday, didn't even get up to that level on Tuesday, and then broke down below both the simple and exponential moving average on Tuesday. So we're going to be watching the 100 period moving averages. We're wondering, there's a little bit of a trend line you could put in here, but not sure how valid that would be. The ease of movement is still below zero, and now it's back to declining after it had been improving, so that's negative. We're still flat with the Arun indicator. We dropped below zero with the S&P McClellan oscillator, so that's now turning negative. So we're starting to decline a little bit based on price, and now we're starting to roll over a little bit based on volume. We also dropped below zero with the NYSE McClellan oscillator, so that's turning negative. And now we're just barely rolling over based on price. Looks like we're still going up just a little bit here based on volume. That might be something potentially positive to hang on to. This has been causing a concern over the last few sessions. We were showing a real improvement with the Swenlin trading oscillator, but then after Friday and Monday, this was continuing to go down. So maybe that was giving us a bit of a heads up. We're still positive since we're above zero, but it is showing some weakness. With the momentum oscillators, we were trying to show some improvement, but we're still below the moving average. We're crossing slightly above the moving average based on price and volume. So that's still showing the momentum, but these are moving average based. So it takes a little longer for them to shift around. We did decline with the PMOs that are rising after we had been improving. We're still going up with the buy signals, and we're still flat with the PMOs that are above zero. We switched over to negative with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR. Here's the slope oscillator, rolling over a little bit, but it's still above its moving average after giving us an extreme negative reading. The MACD is coming back up to its moving average. So we are still seeing some improvement with our oscillators here, except in the long term. They're still more negative. Now, if we see more follow through downside, that could turn these oscillators back down. And we're just kind of in the middle of this whole spaghetti mess. We can't get above the 20 or 50 period moving averages. And for right now, the 100 period moving averages are providing support. This is encouraging, though. We didn't see a real decline with the bullish percent index. It actually went up, and it's above 50 and advancing. This measures the buyer-sell point and figure charts inside of the S&P 500. So the fact that this went up is encouraging for right now. The NYSE bullish percent index, pretty much chopping around sideways, but it's still above 50. And we're continuing to see a bit of an improvement with the NASDAQ 100 bullish percent index. We're still below 50, so we're negative, but we're continuing to go up. The money flow is below 50 and now declining. That's negative. The ultimate oscillator is above 50. That's positive, but now it's declining. And the vortex, even though the red line's coming down, it's still on top, so that's negative. After getting back up to 50, a little bit above with the RSI 14, we're now dropping back below 50. We've already dropped below 50 with the RSI 9. On balance, volume continues to be below a declining moving average. And when we look at the stocks above their 20-period moving averages inside the S&P, we were showing some improvement. Now we're starting to pull back. We're also pulling back. We came right up to the midpoint with the 50-period moving average, and now we're seeing a pullback here. We're declining again with the 100-period moving average study and also declining with the 200-period moving average study. The copy curve is crossing over positive, but again, this is a momentum oscillator, so it can still pick up what it was already calculating and start to switch over and look a little better. The Sean trend meter is declining, and we're kind of more in this neutral area. For right now, the Ichimoku cloud, the bottom of the cloud, is still holding up as support. The Pring bottom fisher after Monday did generate a signal. We don't see much of that happening yet, but it is generating a buy signal. We're turning a little more negative with our Heiken Ashi chart with a dark candle. We're still positive with the Keigi chart, but now we're pointing down. We're negative with the Renko chart, and we're back to looking more negative with the 3-line break. Long term, we're below this R1 level, the 5110 to 5111 level. We got above it just a little bit after Tuesday. Well, we have to close above it on a weekly basis for this to turn more positive. And we're coming down with our 150 and 200 period moving averages, but we're still above this red line, showing that we're extreme positive. And we're now where we had shown all green after Tuesday. The short term is back to all red across the different indexes, and even switched to the intermediate term for the small caps. And we're back to short-term negative with stocks. We're still negative based on bonds, and commodities are getting hit a little bit now in the short term. So we haven't seen that in a while. No change on the decision point scorecard here. And we started off with some blue. Well, Canada has got off to a rough start. And then everything turned red as we got closer to the close. So everything was down, the mega caps and the equal weight index. And so our ratio was down just a little bit. The mega caps were down just a little bit more. The Dow's falling below this pivot point here, and it had overhead resistance at this other pivot point, and it was still below its 50-day moving average. We've turned to negative with the Elder's Impulse system for the diamonds. We dropped below this pivot point for the NASDAQ, and we also dropped below this pivot point for the NASDAQ 100. We've turned over to negative with the QQQs for the Elder's Impulse system. We're right on top of the moving average. We were showing some improvement here with the NASDAQ 100 momentum. Now that could be in doubt. And we're still looking more negative here with the QQQs. We saw the 20 cross below the 50. We cannot get above the 20, and we're falling back from that level. Longer term, though, we're still in an uptrend. And the small caps drop below this pivot point here and just go back down into the lower end of the range that they've been in 2024. We switched over to negative with the Elder's Impulse system for the small caps. We're right on this resistance / support line here. That could be somewhat positive if we can bounce up off of that, but we're not really getting much of a cue from the small caps these days. It looks like they show some strength and then it just kind of fizzles out. Longer term, we're still in an uptrend. We're trying to cross over positive with the momentum, and we dropped below 50 with the RSI. The mid caps cannot get above their 50-day moving average and did see a decline as well on Tuesday. So they've turned over to negative for the Elder's Impulse system for the mid caps. Apple is still below its 50-day moving average. It was down 1.83% and continues to be in a downtrend. Tesla is still doing better, but it's in a downtrend, but it was down over 5.5%. NVIDIA is now coming back down to its 50-day moving average. Microsoft is dropping below its 50-day moving average. And Meta is well below its 50-day moving average, but it was only down about 0.5%. And Amazon, which came out with earnings, by the way, we saw a real sell-off dropping below the 50-day moving average. We may see some support come from that if the market reacts positively to Amazon's earnings. Google, which spiked up and has just been coming back down ever since it saw that all-time high. The FANG index, which was looking more positive, we got just a little above the 50-day moving average. Now we're dropping back below it. And the financial sector, which was hanging out around its 50-day moving average, has also dropped below that. We're seeing a little bit of a turn up here with our staples to tech ratio. In a more positive environment, we want to see this ratio going down. It spiked up. It looked like it was starting to go down. Now it could be turning back up. The dollar's up into the 106 range now, and that's also pressuring stocks. Looking at the S&P, that's in red compared with a one-day lag of the world index. We're seeing the correlated relationship on a short-term basis getting a little bit stronger. We're still flattening with our longer-term correlation. And we're back below the 50-period moving average. We just can't get above that with the total U.S. stock ETF. We were up with the 10-year yield. We were down with the 10-year based on price. And then we were seeing some improvement with our growth to value ratios. We're turning down with the Qs to S&P. We went above the moving average with discretionary to the S&P, but we ticked down just a little bit here. We're still underneath the declining moving average when we look at large cap growth versus large cap value. So in the large caps, mid caps, and small caps, we saw weakness after we thought we were seeing some improvement. We're still okay here with our 10-day average of the S&P 500 highs minus the lows. We're still above 50. But we're dropping more negative now with our 19-day exponential moving average of the advanced decline ratio. We declined below 0 based on price and volume. This coincides with that red and blue chart that I showed earlier on. And we're still looking negative here when we take a 5-period moving average across the broad market of the highs minus the lows. That had been showing some improvement. That could be in doubt now. And we're starting to go back down with our S&P to utilities ratio. We need to see this turn and go back up for it to give more support to the S&P. And we're kind of chopping around here with our staples to S&P ratio. We want to see this going down, and now it could be starting to go back up. And we're not getting a Zwag NYSE breadth thrust yet. We still have a few days left to see if that's actually going to happen. We have until Friday, but we really won't know about this until Monday. Of course, there'll be folks that'll pre-calculate this on Twitter. Finally, I see some people actually talking about that on Twitter, but we need to get up to this red line and get an extreme positive reading by May 3rd for a new Zwag NYSE breadth thrust to be triggered. If that ends up happening, you can see how positive things were after that. So what's our outlook for Wednesday? We're still negative in the short and intermediate term, and we're falling from overhead resistance. We're going to get the MBA Mortgage Applications Index. We're also going to get the ADP employment change, the S&P Global Manufacturing PMI, and then the big one's going to be the ISM Manufacturing Index, the JOLTS job openings, construction spending, and then the big other event is going to be the FOMC announcement at 2 p.m. Eastern. We want to keep an eye on all the crazy things going on in the world. And then Thursday, yeah, we'll get weekly jobless claims and continuing claims, productivity and unit labor costs. That could be rather important. Maybe I should have highlighted that one. But the big one is going to be Friday. The employment situation report and the non-manufacturing PMI will be coming out. So here's the block of all the different things that are going to be coming out in Wednesday's session with their forecasts and then their previous readings, if you find that helpful. Seasonality, we're neutral to positive on May 1st with the Dow, and we're just flat out positive with the S&P. It's a new month, and a lot of times there are inflows. Now, I want to go over this a little bit because it is a new month. So we have the month of May here. Over the last 74 years, for the month of May, we're up 66.8% of the time. We're down 39.8% of the time. Not quite sure that adds up to 100 there. And then I'll deal with options expiration as we get closer to that time. But the first few days of May on a seasonal basis can be positive. But when you take May to October, this is sell in May. The next 6 months are the weakest, depending on how you measure this. This is what Carson came up with, and it ranks last in the 6-month period with an average percent change being down 1.7%, and then we're up 64.9% of the time. Here's the new trading day where we do see some positive seasonality coming into the first day of the month. Wednesday is the most negative day of the month. So we have some real forces working at odds with each other right now. And we're coming back down a little bit here. We're back to this weakness is now more normal type of a thing after we had been seeing a bit of an improvement. We're also seeing a little bit more weakness here. We're trying to get back up to the green line, which was the top quarter during an election year. But then once we get into May, we do see some negative seasonality. It's June and July that on a seasonal basis, we tend to see things more positive. And that's what we're showing here in this chart. As we start to enter into May, the first couple of weeks of May, the first half ends up having not very good returns. But when you look at Carson here, they say that, well, we're up 77.8% of the time during an election year, and we get a return of 2.3%. So, okay, that's from 1950 to now. And it's supposed to be broken down by presidential cycle from May to October. And May does have a pretty good track record, just not very good returns. And then also showing this, summer rallies are common during election years. So there might be a lot of folks that, just not really doing too much right now, maybe getting more defensive. And then we might see some positive action coming in June, July, and August. So our warning signs, both the S&P and NYSE McClellan oscillators, they were back over positive. Now they're negative again. The bullish percent index is negative, but it's still continuing to bounce. The Chaikin money flow is negative. The money flow index, the Copic curve, the vortex, and our oscillators. Those are all negative. And we're still below short, intermediate, and now we're back to being below that long-term weekly chart. Actually, we're now calling it more resistance. So it would just really help the markets if we could get above those levels, and we're just not able to right now. The momentum for the NASDAQ 100 is improving. It's right on top of its moving average, but it's still negative until it's more decisive there. The positive signs, the Swenlin trading oscillator is positive, but it's been declining over the last few sessions, and that's causing a concern. The parabolic SAR is positive. The bullish percent index is still above 50, and that's one of the brighter areas in Tuesday's session. The Chaikin oscillator, the ultimate oscillator, those are still positive, even though they saw some weakness. The long-term trend is still positive. The equity put call ratio for right now is still going down. The financial sector is still positive longer term. And we're wondering, and I finally put in Y in here, are we going to get a new ZWAG NYSE breadth thrust? We still have the setup for it. We don't know if it's actually going to happen. So our conclusion, and we're negative in the short and intermediate term, and we're falling after we were unable to get above overhead resistance. In the short term, we're negative and falling from that overhead resistance. Intermediate term, we're below the resistance levels that we've been fighting against. In the long term, we still continue to be positive. Thank you. I hope you have a really good day. It might end up being kind of an exciting day, so we'll just watch and see how things unfold, and I will talk to you in the next video.